government debt this week. And some economists are treating that with alarm. It really is a sign that our spending, the government spending, in the last 5-6 years has just been out of control.
In today's video, ARK CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
Fiscal policy. Well, we got a downgrade. Fitch downgraded government debt this week. And some economists are treating that with alarm, and others, including strategists, are treating it with a yawn. And the truth is probably somewhere in between, as is usually the case. It really is a sign that our spending, the government spending, in the last 5-6 years has just been out of control. And my reaction to it is, hopefully this is a warning to the legislature and politicians generally that, the spigot is going to have to stop. And it's interesting, as I look in the GDP accounts at the government line, it's actually shrunk as a share of GDP, and most of the spending is not in the GDP report. GDP is production of goods and services in the U.S. economy. And a lot of the spending has moved off into social programs, which are not part of GDP, like, say, defense would be. So I think that topic is going to gain a lot of currency. Maybe they'll skip through it over the election year and campaign season, as they usually do. But I do think Fitch is warning us that we're going to have to deal with this issue in one way or another. Our point of view would be enact policies that encourage very rapid growth, because we're on the threshold of some technologies, as you know, we talk about them all the time, really turbocharging growth. And the best way to get out of a debt problem is to grow out of it. So that's one thing. The other thing that happened that was kind of interesting from a fiscal policy point of view, especially now that we've entered the election campaign season, was movement on crypto legislation in the House. Now, we don't think it will get out of the House because Maxine Waters is head of the Financial Services Committee and is not pro-crypto. But crypto, or as Art Laffer would say, could you please use a different word, like digital assets legislation? We do think that it will become an election year issue. And the fact that it's even stirring in the House at this point in time and becoming a conversation, we think is going to work to the benefit of crypto. And what's very interesting is, whereas we thought we had a bipartisan issue in crypto, the sides seem to part, especially with Elizabeth Warren siding with the banks, interestingly and unbelievably, that we need to be very careful in this realm. We should not trust it. So we thought there was a partisan divide evolving, but we are seeing some Democrats coming back to these bills. There were two that were voted. Well, one has been voted on already, and it got 6 votes from the Democrats. And the next one, that one was on market structure. The next one is on stable coins, and apparently that will have many more than just 6 votes from the Democrats. So this could become, yet again, a bipartisan issue, which we think it should be. Innovation solves problems, and this crypto legislation would really put in place the layer of the internet that no one contemplated in the early days of the internet, because it simply was a place to exchange information. Nobody thought about commerce or financial services. And so we think it's important, and it will take a lot of the cost of financial services out of the system. Then on monetary policy, which is somewhat related, we think, for example, Bitcoin is the first global, private, meaning no government oversight, digital, rules-based monetary system in history. It's a very big idea. And Art Laffer is becoming very excited about this notion that we could be going back to a world of private money. So before 1913, when the Fed came into existence, money was private. And we've done a podcast, you can look for it on our FYI podcast, about this period of time. And while I have always thought it was characterized by booms and busts, and it was, what Art says is those booms and busts happened very quickly, 6 week periods of time before they'd clear up. The booms and busts that have evolved since the Fed took control have been many years in the making, and then when they happen, they are extremely destructive. So just putting in a plug for that. Anyway, on monetary policy this time around, Chairman Powell, in his testimony to Congress, basically used the word restrictive to describe monetary policy, which is a big step, I thought at least. And he wasn't thinking about it in terms of the money supply. And as you know, we've been talking about the money supply falling on a year-over-year basis. And in fact, if you go back into 2021, you'll see that the money supply really hasn't gone anywhere in 2 years. This is extremely unusual and negative year over year, as I've said on all of these calls, since M2 growth turned negative early this year. That we have not seen since the 1930s. And we've also seen a collapse in banks' willingness to lend. They're very worried about the health of the economy, and they're facing even more capital restraints, we've learned in recent days. So monetary policy is restrictive, but Chairman Powell was referring to real rates when he said that. So the Fed funds rate is at roughly 5.5% now. And CPI inflation, that's headline inflation, is 3%. That's 2.5% real rates. And if you look back, you'll see that rate, real rate, 2.5%, was the peak right before 0809. So that's somewhat concerning. But more concerning to me is that the inflation rate is coming down so rapidly now that what if we're at 5.5% on the Fed funds rate and 0 on inflation by the end of this year, which we believe is a real possibility. That would be a 5.5% real rate, and we haven't seen those since the 80s, when the Fed was all about fighting the return of double-digit inflation. That's not where we are right now. So I think that what's going to happen in the next few months, as inflation continues to come down, is that more and more people will be talking about this real rate, which is really starting to mount. And I think it was healthy to hear Chairman Powell refer to monetary policy as restrictive. So half of the solution is understanding the problem. If he thought monetary policy was still too easy, that would be a big problem. So if you look at M2, you can go back to August of 21 and see the same level. And the other thing that I think more and more people are discussing is what Milton Friedman taught everyone, and that is that monetary policy impacts the economy over, and these are variable time periods. I think at times he used 6 months to 18 months. Well, right now we're at about that 18-month period, and we haven't hit a clear-cut recession. We've had rolling recessions, certainly housing and autos, manufacturing, and so forth, but we haven't hit the big one, the recession. And in fact, what's happening, to many people's surprise, is inflation is coming down faster than they have expected. A lot of people were of the view, like Larry Summers, and I think he's still there, that we are closer to a 70s style inflation than most people think. We disagree entirely. And I think many people who follow Larry and others are surprised to see inflation coming down so quickly. And so we're hearing talks of the Goldilocks economy. Goldilocks economy meaning a soft landing in response to monetary policy, and inflation coming down to that 2% area. And then we're on our merry way. But if money and monetary policy, money, interest rates do impact the economy over an 18-month period, well, here we are. If this is the start, what could that mean? Well, it could mean a couple of things. How would we get our soft landing? Well, if prices went down and companies were willing to accept lower margins without firing people. Right now they're hoarding people, and we can see that from the latest employment report. But if they were willing to accept much lower margins as prices come down, then I think we'd have a soft landing because the unemployment rate would not go up. Now, I don't think that's going to happen. I'm very pleased to see inflation doing what we thought it was going to do, but it only means that monetary policy is that much tighter. And I do think that companies now grappling with margin pressure are going to start making tough decisions about employment, especially if the grips of monetary policy get stronger as real interest rates go up. One of the things that I mentioned in our last call, and that we're still noodling over, is this divergence between GDP, gross domestic product here in the United States, and GDI, gross domestic income. Now, they should equal each other over time. They're an identity. But they're measured very differently. And in fact, the income measure is much easier to get at because tax documents are the source of a lot of the data. And so in the first quarter, last time I mentioned to you that on a year-over-year basis, GDP was up, this is nominal GDP, was up 7.2% in the first quarter. And GDI was up only 4.5%. I think I should have also read out the numbers at a seasonally adjusted annual rate, so quarter to quarter annualized. And on that basis, GDP is up, was up 6.1% in the first quarter, but GDI was up only 2.2%. So this is a huge discrepancy. I don't think we've ever seen this big a discrepancy. And it is going to sort itself out. And if we're right, what that means is that the resolution will be revisions in lots of economic data down during the next 6 to 9 months.